Yeah, I'm listening. I'm
Oh,
listening
go ahead,
closely for
David.
this. Yeah, sorry for
That's
the
okay.
cost segregation and appreciation,
Yep.
accelerated depreciation up front.
Hmm.
And so if you could add a couple of sentences there, that's kind of the key interest.
That's the goal for a lot of us. So I'll go ahead and get started. And you can see the screen full presentation now, correct?
Yes.
Okay, good deal. So essentially, we're going to talk about a couple things. Ed wanted to have us present his group because if you talk to him individually, he's been doing our taxes for a good number of years. He's been doing our corporate taxes and personal taxes for some time. I was a real estate investor, single family real estate investor for some time, but I'll introduce myself in a minute. But uh, ultimately, he saw a lot of what we were doing and said, "Hey, I want to go do that." He's been investing with us, and now he also tells some of his clients because of the tax losses and the depreciation we're talking about. So I'll cover a lot of this, but ultimately, a lot of our investors are actively in getting into a number of these topics. We're trying to cover passive investing, so busy professionals, high earners, elite top 10%, earners have the highest taxes a lot of times. So the goal is corporate structure in a right way or real estate investing in the right way to avoid and minimize the taxes. Uh, if a lot of our top earners are, top earners for a reason, they're super busy. They don't have the time to do that. So the passive investing is really what we've identified a few years ago and went all in on. I'll discuss the elephant in the room, what we call it. There's a lot of people that have some hesitation about passive investing, and I'll explain what passive investing is. Talk about that, and then also we have an investment club. So giving investors the opportunity to join our portal, get registered, look at new opportunities. This you can read through this later. I'll have a video that's recorded. I'll send it out. Disclaimer is basically I'm not presenting a deal. I'm not talking about returns or anything like that on a specific opportunity. This is really just informational, and you're in the right spot. Whether you're here, thank you for joining, or watching the video later. If you're an accredited investor, if you are a busy professional, you don't have time to manage physical properties, uh, and you are tired of relying on some of the quote unquote alternative investing, which this is really considered alternative investments compared to like 401k and stock, which feels like just the typical thing that everybody does. Go to work, put some money in a retirement plan, and then you can put it out there. But if you're kind of looking at the stock market, seeing the ups and downs, and been through a few cycles, it's great if you're in it long term and want to put your money in, but it's hard in a downturn. And so that up and down is definitely what we have a lot of our investors want to get out of or just diversify. Some investors want this freedom from passive income. It's hard to pick a stock that just provides dividends only. So these investments provide passive income. So if you're interested in learning any of those, you're in the right spot. The tax portion is what Ed was going to cover. I'll cover it since I don't think he joined, but he can spend some one-on-one time. He does it with all of his clients, and you kind of know. But a little bit about us, like we're Five Talents Capital. So my name is Abel Pacheco. This is us and our logo. And Five Talents for us is it's a very close mission to ours. We want to be a good steward of people's capital. If you look in the Bible, Matthew 25, verses 14 through 30, it kind of summarizes the parable of the five talents. We want to be good stewards of people's money, resources, time, and we want to do right by our investors. And so this is myself and my family. We are all in on commercial real estate right now. I'm a president and principal of Five Talents Capital, and for us, this is our big why. You see my 2-year-old and 4-year-old, my son and daughter, my wife, and I basically spend the majority of my time doing two things: finding new deals and finding new investors. And a lot of my time is spent through education, providing knowledge and insight. I'm a podcast host. We have about 200 shows on the podcast. If you want to go check those out, for Five Talents podcast. And we spend a ton of time networking with other investors. I go all across the country, speak on a bunch of different stages, do a lot of different events. My goal personally when I'm traveling is to get as much education from other people who are doing what we do, and then also network and meet others. But I live here in San Antonio, Texas. I have a background in tech. I worked at Rackspace. If you're both local in San Antonio, or if anybody on the video is local, I worked there since 2006 to 2016. We took a startup, which is about $100 million company when I joined, to $2 billion company when it went public. My background is in leadership development. I love serving others. I love helping people. I had a lot of success in the professional realm, because I realized the more people I helped, the better I did. I found it to be the same exact thing in commercial real estate. It's amazing. So I'm, as I mentioned, father of two. I serve at Greater Joy Church here in San Antonio. I do a little kung fu, and I like hunting. And essentially, this is what I've been doing full time. All these properties in the middle of this slide deck, I wanted to highlight. This is what we're investing in today. So we buy commercial multifamily properties, 100-unit plus deals. We do a little bit of new development. These renders that you see, these are new development renders or rehab renders, but the ones on the outside, the actual pictures of properties we bought here in San Antonio, 268 units. I've invested in 282 units in the middle, 124 doors, multiple, all in about 1,500 doors that we are general partners, owners, syndicators, active participants in the deals. We create these investments for others to put their capital in and to get some amazing tax benefits along with a good return. And I showed this little small house. I invested in single family houses. I did some notes, David. I bought some single family. Sandy, I traded off the MLS. I found off market. I was in a bunch of pocket listings. We did for 10 years. And it really took me some time before we looked at our personal financial statement, me and my wife, and realized, you know what, we are not millionaires. How did that happen? I was the person with the most houses and the most real estate holdings in my circle. But, you know, when I looked at assets minus liabilities, I was not technically $1 million individual net worth, me and my wife. And we're like, well, something went wrong. And that's when we shifted to commercial real estate. So we went from 8 to 800 doors in a matter of 2 years. And then a couple of years later, now we're in about 1,500 doors. So I highlight that single family. This is my dad with the cowboy hat and my sister. This is the house we grew up in Corpus Christi, Texas. It was a 2-bedroom house, and there was 5 of us. I have 2 older sisters. And my dad turned this into a rental. I saw him do that when I was younger. We'd go to this house and pick up checks. And for all those years, I was thinking this is how real estate portfolios get created. The only way, it was when we went to commercial real estate that I started saying, okay, let me go, work on a different model and a different entity. So, Sandy, you having a question on accredited investors? We work with both accredited and non-accredited investors. Accredited investors, typically we have $1 million net worth or more. And people that are not accredited investors can still get in these deals with a personal relationship with somebody who's doing the deal. So the fact that we're talking now, we've established an existing relationship. So we work with SEC regulated deals, and we provide these investments to others. So usually a lot of people that are high earning are typically that, and you're paying a lot of taxes. So these types of properties are the ones that we're helping others attain.
Hey,
yes,
so
sir.
even though you and your wife, after all that journey, figured out you weren't millionaires,
Yeah.
You still won't work with regular guys just like you were. You have to be accredited now.
No, the other way around. Sorry if I misrepresented that. We work with a lot of accredited investors, but I was not the millionaire. My first deals that I invested in, I was a non-accredited investor. My dad is still not an accredited investor, and we can work with accredited investors. The SEC gives us some extra guidelines, because what we do is we do these Regulation D, 506B, and C investments. And so the SEC says you can take 35 non-accredited investors in any single deal as long as everybody has a pre-existing relationship. So now that we've got one established, we're following the rules. We do allow non-accredited investors to get in the deal. So thanks for clarifying, David. Thanks for the video too. Yes, we work with both. And that's, primarily that's one of the biggest reasons why these rules changed in 2012, 2013. The Obama administration passed the Jumpstart a Small Business Act, the Jobs Act, and it allowed non-accredited investors to start getting in. Before, you had to be in, like literally in the club. There was no advertising. You could not send something out. You had to be an accredited investor to take advantage of these. So now, since we've opened it up, we really have done the same. We've let everyday investors in with us. Anybody that's trying to put some money to work and avoid taxes, just like the wealthy do, right? So we want to build wealth like the 1%, and so that's what we do. Thank you for clarifying. I'll keep going through this. A lot of people, want a little bit of background testimonial. Hey, who's Abel? How's his integrity? How's his knowledge? Does he help others? Does he help the community? These are some of the people in my past that I've worked with. So the goal is for us, I want to be, have the highest integrity, provide good disclosure for everything that we're doing, provide that, servant leadership approach that I still had back then, and just doing what we do now. So what we aim to do, I mentioned, is apartment buildings. We do a little bit of build to rent, and we do a little bit of triple net lease, but really our 95% of what we do is apartment buildings. And the reason we like apartment buildings is they give cash flow. I put some money in, money comes back to me. That's probably the most popular one. That they're very high demand housing right now, especially where we're investing here in San Antonio, Texas, and South Texas. It is essentially for us a low supply market with a very high demand. If you Google population increase in San Antonio, Texas, or South Texas, you'll see a ton of new population growth every year. And the supply of new housing is behind nationwide about 5 million doors. So when you look at that, it's crazy. It's going to take a long time for us to catch up. But here in South Texas, we do extremely well because it provides a hedge against inflation. So as supply is low, demand is high, price follows the demand curve. And today, in an inflationary environment, when their dollar is diminishing, eroding the buying power, we get the ability to invest and have the hedge against inflation. And then tax benefit, right, David? This is what you're talking about. Sandy, I heard the same, which is, how do I put some money to work and avoid taxes? As real estate professionals, they get the best ones. Ed can talk about it, and I can dip into it a little bit, but we also do this for appreciation. If you're not a real estate professional and you just want a good return, the property has good appreciation and then economies of scale. It takes a good amount of effort to find one single family good house that's it's going to make some good return. Finding the property, working with the contractor, turning it, selling it, and that takes some time. Well, in that same 6 to 8 months period, we could find 100 doors, meaning one apartment complex, do one transaction, one deal, and now we've got 100 doors working the same way, because that's what we do. Is we buy them, we work with the contractors, fix them up, rents go up, the value goes up, and instead of one door at a time, it's 100 or 200. And we like the leverage too. Banks give us 70% plus of the dollar amount. So if the deal is $20 million, they're going to give us a loan for 16, and we come up with the difference. So we don't need $20 million to go buy the building. We just need 4. We have a couple of, maybe $1 million or 2 for renovation. And that's essentially where our investors come in. We also do development. We build properties, multifamily apartment complexes, and also small community subdivisions, and we rent them out. Instead of selling the houses one by one, we just rent them all out like an apartment complex. So think of it as a horizontal apartment complex. Instead of going up, we go vertical, and then everybody has a yard, backyard, garage, and a community area, but we rent them out. It operates the exact same way as multifamily from a financial standpoint. and then we create that community. We rent them out much higher rents than the units, but people that can't afford to buy a house, or maybe their credit score is not, it doesn't qualify, but they have enough means to pay for that, and they have a big family, they do that. We also do a little bit of triple net lease. I mentioned commercial, industrial warehouses, things like that. But really our prime, core is multifamily apartment complexes. So before I move, any questions? Is this good speed, good pace? If y'all have any questions, feel free to jump in. Happy to have you jump in.
Good.
Okay, good deal. So the biggest thing that I see with these deals, or people ask us, is like the elephant in the room, right? Is, hey, I'm putting my money into a property and I don't know how I'm going to get my money back. Is it going into real estate? Is it going to be invested into the deal? I don't have any control, and I'm looking at this, this investment. I signed, I wired money. Am I going to get it back? Right. And that is a big, probably the biggest fear. If somebody who's never done that before, if you haven't worked with a professional, or you haven't gotten a good referral, you're finding somebody on the internet, all of these things are, very valid fears. And that's, probably what I come across the most is like, man, are you going to Bernie Madoff us? We're going to put some money out and then it's never comes back in. Also, people have fears of like, hey, are the books being kept correctly? Are y'all making the right decisions? Just genuinely avoidable mistakes, whether you're putting your money in to a team that is, not reputable, or just frankly fraudulent or criminal, or you put it together with somebody and they don't have any malintent, but the deal doesn't go right. So all of these things are really challenges from passive investing. I put my money out, is it going to come back? And how do I realistically do that? Well, in the bigger world of passive investing, outside of commercial real estate, syndications, and what we're doing, it's still the same. Whether it's, communication, reporting, lack of transparency, I don't really have an understanding of what's going on. Maybe the people doing the deals have really speculative projections. They promised me distributions, I never got them. You may not be able to get a hold of people working the deals, the principals or general partners. Tax time is an extra complication. I would say most of y'all working with Ed, you kind of realize, anytime you create new structure, it's going to take extra time to do those taxes. But some people are not comfortable or familiar with extending the taxes out to October. A lot of our investors have to do that just because of K1s and introducing a little bit extra complication. And, frankly, it's like, I've got my life savings out there and this is what I worked on my life and I'm handing it over. Right? Sleepless nights. So these are all very valid fears. So what essentially we've been able to do for our investors is to create this experience where we believe gives people fully transparent investing experiences, where our relationship matters, not only from the SEC stuff we were talking about earlier, David, but in the investment. Because if an investor comes in and works with us, we don't want just them to work with us on one deal. We believe and project that we're going to be doing this for the next 15, 20, 25 years. So we want investors that are going to work with us on not one deal, the second deal, third deal, referrals to other investors. And so we create that with the transparency, with monthly communication, monthly visibility, quarterly reports, the financials once a quarter, providing investors K1s. Some partners don't do these things, which kind of boggles my mind. These are kind of like the minimums that I think should be done. Need to provide some communication, need to provide a K1. It has to be done from a tax perspective to tie everything back to, from the IRS to the investor to Ed doing the taxes. And those are the things that we're trying to do. Lastly, it's a conservative approach. We want to underpromise and overdeliver on an investment projection. So our goal is really double-digit returns with good tax benefit. So this is the biggest single bullet. When people ask me, how much if I put out $50K, $100,000 with your investment, how much am I going to get back? Our goal is to at least provide a double-digit return, 10 plus, we typically will show investors an offering memorandum on every single deal with 15 to 18% return. So some kind of average. And the big goal, if you wanted to summarize all the cash flow, all the appreciation at sale, we're aiming to double investors' money in about 6 years, turning 100K into about 200K passively, not including the benefits of the tax return. So a lot of active investors see that it's kind of too conservative. It's too low. It's not exactly what I was looking for. I wanted higher return. I wanted faster, and it's a risk adjusted return. So if you want higher return and faster, you're going to take more risk. You're going to do the work yourself, put time, effort, and energy. If you want to do the opposite, which is a lower risk, lower yield, no work, this is exactly what we do for our investors. So also out of every deal, we give back to local nonprofits. We've got a big focus right now on foster children. Through is kind of the next nonprofit that I think we're focusing on. We give back to a couple of different entities here in San Antonio, Texas. We like giving back to communities we're investing in, but that is a percentage of all of our profits go to. We do the Battered Women's Shelter, we do the SA Hope Center, et cetera, et cetera. So these don't mess with the returns. The returns are net of any of this stuff. But also, anytime we have some money out, we want to make ourselves accessible. So we're all accessible, all of the general partners to all of our investors. So we really provide that, direct access and trying to provide peace of mind. So I had a couple extra testimonials about, the us giving back. Focus for us is really to provide as much expertise, education, insight, knowledge as we can. We do that through our podcast, and that's just free education, a couple hundred shows of it. And then also for us have, high integrity, provide a good environment for people to learn and provide, that servant leadership mentality for investors as well. So a lot of people, I think the next thing, trying to cut a little short here or go faster so you can have time for questions. It's this sourcing deal. So how do we find these deals is probably the biggest area for people to ask is once they are in, they go, well, we end up saying no a lot more than yes. We look through like 50, 60, 70, 80, 100 deals with the brokers, commercial brokers, off-market properties. We work with direct owners. We were in a lot of different apartment associations, et cetera. And we target markets that have good median incomes and a good consistent increase in demand for housing. So primarily South Texas. We live here. I live here in San Antonio. My family's from South Texas. I had a Pacheco, Luciano Pacheco, fight in the Battle of the Alamo, and our family's in the Sons and Daughters of Republic of Texas. So like we're here, this is our home, and this is where we like to invest in. So we invest in properties that force appreciation up, good value add strategy. We typically have anywhere from 3 to 6 years is kind of like a projected date. Sometimes we sell early. Majority of time, I tell investors prepare to hold for 6 years just in case. But to change the bullet around a little bit, it's 5 is what we typically put in the OM. Typically, every deal is a little different. We want investors to start receiving checks after this initial stabilization. So we buy the deal. After we buy the deal, we take over. Property management comes in. We do the renovation, start pushing rents up. The asset starts generating more cash flow, and that's when we start distributing cash flow. And then again, our goal is to double money in about 6 years is roughly the goal. So 100K investor. Typically, the minimums are about 50K investments. Some investors put in more. It's all an equivalent. So somebody who puts in 50 is looking to get 100. Somebody who puts in 500K is looking to get $1 million. And that's leads to like what exactly this is deal example or case study. Edgar, also, I'm going to have a property tour, an open house this Saturday, May the 28th. If you're in the area, Leon Valley, we bought an apartment complex in September, and we're going to do a property tour on that one. So we have it here. And let me see. So this case study, San Antonio. This is a 124 unit property that we acquired in 2019. We sold it in 2021. And you might hear my little one in the background. Apologies. So
You cut off.
hold on, Bubba. Hold on. So there's my little one. There's my 2-year-old. He's like, I hear you at work, Dada. I go, yep, I'm here, Bubba. Okay, so this property we bought 2019, 124 doors, kind of before and after. Typically, we want a great experience from the time a potential renter drives on the property, looks around, goes to the leasing office like this. So this literal entryway and a nice, beautiful, front office. They take them through the pool and a model unit. And that model unit looks beautiful. Spend a ton of money on it. We want to make sure it looks good. And that's kind of how we end up doing it. So this was a $2.35 million equity raise for investors. The 2.35 million came in, maybe 20, 30 investors. We put in 600K, half a million dollars of improvement. We projected 19% average annual return and we delivered 29%. So again, under promise, over deliver. That's the goal. Have a nice occupied property, 92%, and a very clean asset. We gave investors 8% preferred returns, meaning usually the cash flow matches. If somebody puts in 100K, that preferred return that they're accruing is about $8,000 a year. And that's what we're distributing out quarterly on this deal. We told everyone 5 years and then we sold in 2.5, right? So that was kind of the under promise, over deliver. We bought it through a broker, and because we're local buyer, local presence, local experience, we won the deal. So this is kind of a one-page placard. We bought it in 7.875 million, and then a couple of years later, we sold it for 12, right? So that is the high level. This is a case study. Another one we bought in February, just this year, so a few months ago, 170 units right down the street from Rackspace. We told everyone a 15 to 18%, range. We gave everyone a 7% preferred return, which usually matches to the cash flow. So the 100K investor is looking for about 7K a year of preferred return or cash flow. And we did let open to accredited and what we call sophisticated investors. The SEC says they're not accredited, but you have enough understanding to say it's an investment. Every investment's a risk. We could make money or lose money. And so the SEC requires that we have that relationship in advance. But anyways, $19 million property. We put 750K of renovation. Closing costs, you see the total capitalization for that deal was 21 million. It's a 1982 property. And on this one thing to notice, this is a little bit more information, a little more in depth to catch. But once you start working on these deals, you get a good understanding. The goal for Class A structure on the right-hand side, you see 70%. Out of every dollar that's invested, the members' equity, our passive investors get 70% of all the profits. So they do no work. They put the investment in. They get tax returns, which will hit that, right now as well. But they get 70% of all the profits. This is why the double the money part comes in, right? Let me go to, I'm going to stick right here to, where is this? I'll keep it on the slide for a minute for tax benefits. So I think this is what, a lot of us through Ed, when I started working with him several years ago, I was buying single family houses and I was like, how do I do this? So when I converted to multifamily and I found out how wealthy really, minimize their taxes, this is what he told me. It is the tax benefit portion that is so valuable. We do something called a cost segregation study on every single property. So this purchase price, if you can see 19.2 million, roughly speaking, about 17 million from the IRS, they let us write off $19 million. Or sorry, 17 million. You take the entire purchase price minus the value of the land, and we write off the difference. So that is not an unusual thing. It happens every single day in real estate investing. What happens is when we hire an engineer, they're a cost segregation expert. that engineering firm goes through the property and they evaluate this 170 units. And what a cost segregation means, or a cost segregation study, it segregates what can be written off in 1 year, 3 years, 5 years, and over the length of the property. Typically, on the tax side, the IRS lets you write off residential real estate, this is considered residential. It gets written off over 27 and a half years. This is why this stuff is so powerful. On a note that you buy, on a single family property that you buy, I'm going to use a round number and say $200,000. We bought a property, it's cost 200 grand. Well, the government, IRS, lets us divide it by 27 and a half year schedule. They let us write off $7,272 a year. That's the most we can write off. But if we do a cost segregation study, the engineers take it, they give it back to the IRS, and they let us do something called accelerated depreciation. It would be like squeezing the $200,000 tax benefit into the first 5 years, not 27. So not writing off $7,200 a year, but you'd be squeezing $40,000 of losses in every year. That's the rough general, insight. Ed's the expert. He'll explain it. I was hoping he was here with us, but whatever, he's a busy guy. You can talk to him one-on-one and kind of do that. But that's the gist of it. You're taking $200K in a single family property and you can do it in $40,000 chunks a year. The reason it doesn't happen like that is because typically there's not enough meat on the bone to actually have a cost segregation study and it be a meaningful difference to do accelerated appreciation. But since these deals are so big, they do have a meaningful, point. So if it's $17 million that we're writing off, now I divide it by 5 years and we're writing off $3.4 million of tax losses every year. And if we only raised a few $1,000,000, every investor gets their equivalent percentage of that millions and millions of dollars of tax losses. To get to the punchline, I'll use my experience so you can put in real numbers here. I, as a full-time employee in W-2, when I was working at Rackspace, actually the year after I was working at Hostway, another, it's an IT hosting guy. I was a W-2 employee. My best year was I made $300,000 in W-2. I was paying $60,000 in taxes every year before that. And what happened was my wife stayed home from work that year. She was the real estate professional in the house. And because she was a real estate professional, she got to take the losses from our passive investments. We put in $100,000 of cash and we wrote off about $60,000, $69,000 of taxes. So even though I was an employee paying, getting paid $300K and having a $60,000 tax bill, we got to completely eliminate that. That's what allowed my wife to stay home from work, become the the real estate professional, take all of our losses. And that's typically what we give to investors. We give them, roughly speaking, every deal's different, but roughly speaking, they see about 40 to 50% plus of the dollars invested into the deals. So that tax benefit is not included in any of the returns that I've been talking about. So we want to double investors' money, literally from cash in, cash out. But the icing on the cake, which could almost be considered the cake, would be the tax benefits. That's why Ed, when he started looking at our tax returns and some of our other partners' tax returns, they were like, okay, I need to go do what you're doing. Let's get in. Our clients, our investors, people with us need to kind of break in the door. So that's what we essentially, we provide these, double-digit returns, highlight the good tax benefit. I'll go through this last portion and I'll ask, answer any questions because there's probably a lot from the tax perspective or just in general. These investments, the only kicker, the catch, right? Some people go, it's always too good to be true. What's the catch? The catch is there's a lot of people who want in these deals. So If we are underwriting 50, 60, 70, 100 deals before one works, typically we only find about 4 to 5 deals a year at most. And if a deal has $5 million worth of capital investor room, there's big investors that want to put $1 million sometimes. Typically most of our investors put in 50 to 100K, but it's this first come, first serve that's hard. Depending on the deal, the minimum is usually not the issue. It's SEC only gives us 35 spots for non-accredited investors. The deal fills up quickly and XYZ. But if you're interested and you want to get on, we can talk one-on-one. I can answer some general questions that you don't mind asking with the group, or have it on the recording, but we can talk one-on-one. We can cover the tax benefits as an individual. And then here's the website, www.5talents.capital. You can go to that website. That's our direct website. And when you get there, www.5talents.capital, there's a little bit more information. You can go schedule time with us, and we can get you on our investment portal. You can register and then see past deals and also future deals. So let me stop talking, and see what questions any of you have, if you have some questions. Questions. How did I do? How did I present the information? Okay, easy to understand.
Yeah, good job, Abel. One question. One of the earlier slides said that you're able to take retirement money.
Oh, yes.
But you don't get the tax breaks. You don't get to leverage the tax breaks if you do it that way, right?
There's pros and cons. A cash investor gets the tax breaks up front, right? But when we sell that property, there's another problem that gets created. It's called capital gains, right? We made 100. That was my basis. We spat out 100, another 100K. So there's 200. So the basis is what gets capital gains taxed. Our investors, if they're cash investors, their goal is to invest in another deal in the same year one sells. So they have a new fresh set of losses. They're kind of kicking the can down. It's kind of like your own personal 1031 without some of the rules, but we're avoiding taxes. We're deferring them. Defer. So that's the cash investor gets the tax benefit up front, but they pay the capital gains tax at the end. The IRA investor, the solo 401k investor, the retirement plan investor doesn't have to take any penalty for pulling money out of your current retirement plan. You just have to move it into a vehicle that's within the tax plan that does not ding you for moving it into, like a self-directed IRA is the most common example, or solo 401k. You can move a 401k, move it in there. You can direct that money into our deals, but there is no tax benefit up front because you're already in a tax sheltered environment. The fact that it's in an IRA or a 401k or solo all those different vehicles, you already tax sheltered. There's no taxes. So that means you get the benefit at the end. When the deal sells and the capital gains comes in, those investors don't pay capital gains taxes. So it's kind of like a pro and a con. My first deals that I invested in, I didn't have 50K cash at the time. So I moved some of my 401k from my professional job at Rackspace. And then I moved from 401k into a self-directed IRA. And that's what I invested in our first 128 unit property in Seguin. And so I didn't get the tax benefit up front, but when the deal sold, I didn't pay any capital gains taxes. Then because I was a single family investor, as I mentioned, what we started doing is we refinanced some of the single family houses, pulled my cash out. That's what I invested in my later deals. And that's how I got the cost segregation accelerated appreciation benefit when I was a cash investor. So pro and con either or. Hopefully, does that help answer the question, David?
Yes.
Yeah. Different strategies. Some people want to be active and actually be a syndicator like me. They want to put the deals together. They want to do the active work. They want to get involved. If that's the case, you can't invest your own IRA money into your own deal if you're active in it. You can only do it if you're passive. So that's kind of like what I did. I invested all of my IRA money first, all my 401k that was moved into a self-directed IRA, and I invested all of that first. Then when I had cash, we started doing our own deals, and I can put my cash into my own deals. So anyways, couple of different strategies here, but what else? What else? A good question.
The opportunities are only for 50 plus.
Yes,
Or-
typically $50,000 is our minimum investment.
Okay.
I will tell you every once in a while, because every deal is different, right? Every once in a while, I'll give my dad away. Again, every once in a while, those 35 spots for non-accredited investors don't get filled up, and we'll have somebody come in a little bit less. But thanks, Pop. So my dad, he's invested in a couple deals and didn't quite have the whole. So he's like, yeah, it's not an SEC rule. It's just a personal rule. All we're trying to do is avoid filling up the 35 spots before we have our investment total in. So somebody with 40, 45, it happens with have somebody in, but that's typical. Anywhere typical is 50 to 100K plus, and every once in a while on the flip side, we'll have $1 million investor come in, and that's like, okay, great. It definitely does not take up the 35 accredited spots once you have one big investor come in.
Got it.
All right, good questions. What else? All right. Well, I mean, for us, this is the end, and I have the recording. I have what else? The Eventbrite. Shoot, I wish I was prepared for this and I forgot. Let me get this link here, and I'll see if I can put it through chat. If anybody is available on Saturday, one deal, 108 units is the deal that we are going to showcase. It's not one of the case studies that I talked about now, but it was a property we bought for $10 million in September of 2021, so last year. And we spent about $1 million in renovation, roughly speaking, renovation cost. And in that, let's see here, stop this share. And in that, we just basically finished our plan, our renovation model. So what was the plan on this deal was the roof was replaced. We replaced or restriped and recovered the parking lot. I'll put this in the chat. Where is my chat? Show the chat. Oh, here it is. I think this is it. Attendees. Yep. Host and panelists. This link right here. We did model units. We did some of the community areas, the pool, the amenities, the landscaping. We haven't completed the signage yet. That's next. But we did a clubhouse. Clubhouse was inoperable at the time. We made it to a really nice kind of yoga, coffee area, upstairs patio, that type of thing. So we're going to be on site looking at the property if you're interested, and you can jump in, you can register here. And then that's Saturday from 4 to 6 is the property tour. And then the dinner, we're going to do a little investor appreciation dinner. You all are invited. So if you can make it to Kirby's afterwards, we're doing a nice evening. And that's about it.
Good job, Abel. Thank you so much.
Thanks, David.
Thank
Sandy?
you.
Thank you very much for your time. Edgar, good to meet you virtually. And talk soon. Talk to everyone soon. Bye-bye.
Bye-bye.
Goodbye.